Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark will run down the action on the major equity markets going into Canada Day. Martin Armstrong from Armstrong Economics believes the stock markets still have room to go substantially higher, but will we see a minor correction at least in the next few months? Armstrong will tell us what he believes will stimulate the economy the most, government spending or lower taxes. He also comments on what it means when real estate prices peak. Plus, at the end of the show today, we'll have a company showcase update with American Manganese President and CEO Larry Reaugh. We'll talk to Ross Clark right after this.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Happy Canada Day, Ross, and happy Independence Day for our American listeners.
It's going to be one of those strange weekends that becomes a four-dayer for most of us in Canada who are involved in the financial service business.
And for those of us who have relatives in Seattle or Washington State, the Canadian dollar is doing decently well. And
I would think it will be very busy at the borders this weekend. And, we haven't seen good strength in the Canadian dollar like this in quite a while. It's very, very nice to see. And really, you think back, it's only a month and a half ago, the Canadian dollar was down and challenging the lows that we'd seen at the end of the year, and the sentiment numbers at that point were just so bearish. Everybody was thinking that as oil was starting to break from the $50 level and starting to step down, and the grain prices were under pressure, everybody was starting to become exceptionally bearish, and we saw the commitment of traders numbers, which showed the positions of the commercials and the speculative non-commercials. We saw those numbers get out to extremes that we hadn't seen in literally a couple of decades. And when you get that over balanced on positions, it only takes a small turn to get some momentum going back the other way. And so here we are. We finish off this week, and we're finally starting to see some numbers on the COTs that could say that could be getting towards the top end of the rally. And considering the hawkish comments that we've had out of the Bank of Canada for the last few weeks regarding state of the economy and the potential for an interest rate hike here in the middle of July, this could be the classic of be long when the rumor is in place and sell into the news when it comes out. So I'd be looking at the Canadian dollar upwards around the 78-cent level. Middle of the month is a pretty good level to be selling into.
Is that something that the Bank of Canada would really want to see?
Well, I think the Bank of Canada, they're always worried about the employment and inflation, and they needed to see some movement up here in interest rates. And I think, a Canadian dollar, if it's going to be bound by maybe 70 cents on the low end and 80 cents on the top end, that type of range is acceptable for them. They don't like to see the big swings, and keeping it down at a reasonable level here under 80 still keeps us competitive on an international basis.
The so-called FAANGs, are people still hanging in with them, or are they starting to think they're just overpriced and it's time to get out?
Oh, well, we're definitely going through the rotation. The FAANGs, pretty much as a group here. So this is Facebook, Amazon, Apple, Netflix, and Google. They have all had big momentum moves into about a month and a half ago, and most of them now have created these double tops. They had an initial sell-off early in June, came back and have had failed rallies, and only one of them, Facebook now, is managing to hold above its 50-day average. So we've been talking about how the market was ready to have this move from growth back more to value, and that is really showing up. So with the FAANGs having tired out, and that would also include most of your tech stocks, consumer discretionary stocks as well. On the other side of the coin, the banks, the financials, and that would be like the XLF ETF in the U.S., the Lifecos, healthcare, biotechs, they've all come to life here. And so this is classic rotation. You can continue to have a bull market as long as you're having new leadership. And so where I've been thinking we can get a correction into the late June through July period, and we are starting to see that volatility and correction come into play, it's nice to see that the new leadership is coming along. And, it was a week ago we talked about the fact that we had our second Hindenburg signal, that indicating that we had a significant number of new 52-week highs and 52-week lows within this long uptrend, and that such divergences would make us vulnerable to some pretty good corrections. And so we saw the VIX, which measures the volatility, it had been playing under 10, which was down near the historical lows, and this week spiked up to 15, middle of the week, as we had an initial break in the market, and now it's back down around 10.5. So volatility starting to come back in, which I think is good. You need enough of that to create opportunities in the market, and clearly there are those opportunities presenting themselves.
Ross, I hope your family has a great Canada Day, and for our American listeners, of course, a great Independence Day coming up.
Yeah, it's all the best to you, your family, and our listeners.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy, Vancouver. Next on This Week in Money, Martin Armstrong.
Always consult your investment professional before making any investment decision.
Aven Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aven's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avenresources.com.
I'm Larry Ray, President and CEO of American Manganese Ink, listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Martin Armstrong, founder of Armstrong Economics, available online at armstrongeconomics.com. He's speaking to us from New Jersey. Martin, welcome back to This Week in Money.
Well, thank you for inviting me.
Martin, we keep hearing stories that the major equity markets are likely to crash sometime this year, probably in the fall, like they do if you follow tradition. What do you see ahead for the Dow and the S&P 500?
Well, sure. We'll get a correction, a minor one, and they're all going to say, "See, we told you." But just ask yourself this: if governments are in trouble, where are you going to put your money? Are you going to run down to the bank and say, "Gee, can I give it all to you at no interest or 0.2%?" This is what they don't get, is that sometimes the private sector is in trouble. Other times, historically, it's government that's in trouble. And we're in one of these waves where the governments are collapsing everywhere. You have pension crisis hitting in Switzerland, in Germany, everywhere you go. It's largely because of this socialism that has developed since World War II. And you immediately say, oh, people, it's socialism, we should care about people. If you look at really what goes on, all right, about 70% of national debt are accumulative interest. All right, they always say, oh, we're going to tax the rich, we'll make them pay. Does it ever lower anybody else's taxes? No. It just puts more money in their pocket. That's it. All right, so it never goes to the poor or anything else, and they're cutting, benefits in every which direction they possibly can because they can't afford it. The pension crisis is all about they promised whatever. Oh, yeah, okay, fine, go back to work here, we sign this. It's not funded. And government is, if it's a private company you work for and they did that, they'd be in prison. When government does it, good luck. There's nothing you can do. They got the tanks and the guns. So that's really what's happening. And the stock market is going to move substantially higher. I wrote a piece that this is the most hated bull market in history. From the roaring 1920s, it was a 97-month rally. We reached that point in April. Back then, shoeshine boys are getting rich and everybody's investing in the stock market. What do you have this time? Oh, stay away from it. It's going to crash any day. I tell you, look, that's it. This is the most bearish market ever. I had 3 interview requests, and from people, hey, I really didn't know. I said, what is it that why are you asking me to do an interview? And quite frankly, 3 of them said, well, we're just trying to find somebody who's at least bullish on the stock market. He said, everybody we have is negative. And all I can tell you is the majority is always wrong. And that's why the market's been going up. We said back in the beginning of this whole thing, we were going to take off and make new highs. You can see it on our site. Barron's wrote an article saying, oh, Armstrong says new highs. And it's kind of like a tongue-in-cheek piece. They like, ha, yeah, sure, like that's going to happen. And they wrote back in 2011. All right? Who's got the last laugh? It's all about capital, and this time it's government that's in trouble. It's not the private sector. And the other thing they don't understand, they talk about PE ratios, etc. Fine. The dot-com bubble, PE ratio reached 50. What is the historical high? It's 2009 at 200. The PE ratio goes up dramatically in a financial crisis. Why? Because at that point in time, if you don't trust the banks, you don't trust government, where are you going to put your money? They buy blue chips. That's what they do. They take the money and just put it there, and there's a substantial difference. If you take the famous bank that went bust in the 1930s, which set off the banking crisis. It had the, fateful name of the Bank of the United States in New York. And when it went bust, it set off a panic, whatever. Okay, fine, went into bankruptcy, etc., and sold all the assets. What did the people get? 92 cents on the dollar. If a government goes bust, sorry, you get nothing. Government debt is the worst because it's always unsecured. They have the tanks, the guns, and you can't do anything. You can't go down and start grabbing Picassos or anything like that. It's it. And they sell a wonderful propaganda story. Oh, government debt's AAA. It's all this other kind of stuff. It's secure. Why is it secure? Historically, AAA corporate debt does not default. Government always defaults, without exception. So, I think the odds are on the opposite side. And that's what we're seeing. I mean, Illinois is in trouble. I mean, every state you look at. Quebec, Germany, it's everywhere. It's absolutely everywhere because politicians have done the same thing. Vote for me and I'll give you X, Y, Z. And it's just not there. It's not funded. I mean, that's the astonishing thing that, they call Keynesian economics, etc. Well, Keynes also said, all right, he said in a recession, you stimulate it by lowering taxes. They don't want to listen to that part. They only want to listen to the part in a depression when there's no demand from the private sector, the government can run deficits. Well, they took that and they said, thank you very much, and they run it every year.
Martin, it seems to me even in good times they run deficits.
Yeah, I mean, this is the problem. It's, why do you think that they are so against Trump? Because they don't want anybody coming in from the private sector. As long as it's somebody who's dyed in the wool, career politician, they know the game. And, okay, fine, promise whatever you want, and you don't do it. All right? But when you take anybody from the private sector and you put them in there, and the first thing you get is like, oh my God, he's going to start doing things, he's going to upset the the apple cart here. That's why they're so against Trump. And when Ronald Reagan was elected, the same kind of panic was taking place in Washington. They're going, oh, he's not really a federal career politician, and they were, well, we're going to have to train him. They were scared. They don't want anybody that's going to upset anything. That's just the way it is, unfortunately.
Are there any indicators or catalysts that could change your mind on the U.S. markets?
No. You're talking about an absolute miracle, that would have to, something's going to come down from heaven and politicians are going to get religion. It just doesn't work that way. People, I'm against the gold standard. They don't understand the problem. We've had gold standards 2 or 3 times. They always fail. Why? Because the issue isn't money. It isn't what you call money. It's the issue is always about who do you put in charge of it. And we were on Bretton Woods, fine, gold standard. They kept gold at $35 an ounce, and they continued to spend without any thought. Okay, fine, you said this is a fixed rate, but you can constantly increase the supply of dollars. Don't you think a 2-year-old with a pocket calculator could figure out that Bretton Woods would collapse? I mean, these people are incorrigible. And I've worked with governments around the world, from Europe to Asia. And it's astonishing. It's absolutely astonishing. But we elect the worst possible people, and they have no personal experience, and they're just career politicians, and that's it. I mean, you might as well hop in a cab, and if you need, a root canal, gee, you have a nice smile. Would you mind, working on my teeth? Yeah, sure, why not? I mean, it's amazing. But we put people in power who have absolutely no qualification for the job whatsoever.
Who should our politicians be?
I honestly think that it should be the only political system historically that I ever saw that was fair and honest was the city of Genoa. And what it was, it was fine, they had the ruling families, but the position of the Doge rotated annually. So what happened was, very interesting, nobody would ever pass a law that was against themselves, because they're going to be right back in the fold the following year. And fine, they were the rich. However, there wasn't this Marxist battle of class. It was like they took Genoa and ran it like a company in competing against Florence and Venice. Everybody benefited. I mean, it's been this class warfare stuff largely began with Marx coming in the 19th century. And part of the problem was that was the birth of the Industrial Revolution. All right, so yes, there was a lot of abuses, but they were not abuses in the sense of deliberate things. It was a sense of learning worker safety. You know, they would lock the doors, and everybody died in the building when it set fire, because they never thought about that. Oh, okay. But we don't really need all these unions and things anymore, because basically all those types of laws have been passed. You have, worker rights, etc. And it's been, so it was this classic issue that what really inspired Marx, honestly, goes back to Aristotle. And Aristotle, when Athens became the new financial capital after Babylon failed, he called the people who made money from money. So what they were doing was basically it was developing a market economy. So they would go to the farmer and say, look, if you would actually grow some extra crops, we could probably sell it to somebody else. So he viewed it that it was changing the economy, that people were now, becoming more of a market economy, and he felt that it was destroying the old way of doing things, which was a villa. And a villa was basically that everybody was a self-sustaining unit. You grew enough food for everybody that lived in the villa. That was basically it. There was no market to go sell excess to. So, that really influenced Marx, and we have a lot of this stuff that has carried on, and it sounds great. Look, you have Corbyn over there in Britain, and you're watching the British economy fall apart if he gets a hold of it. He doesn't want to put in a minimum wage. Oh, we're going to put in a maximum wage. If you go to Britain today, the best doctors have all migrated to the United States. I have friends that are there. The health care is absolutely abysmal. Why? Because they're government employees. That's it. They can't make a substantial amount of money, and if they're any good, they hop on a plane and they come to the States and they can get in, and they make a lot of money. So what's left is basically the slim pickings, and if you put a maximum wage, they're just going to pick up and move to New York. That's it. You should be looking at the politicians. Hillary Clinton goes in as a career politician, bankrupt when they leave, and now worth hundreds of millions of dollars as a politician. It's not much better. You can go right down the list from Pelosi to, to everybody. They're all that way. That's one of the things they don't like about Trump. He said he passed a rule that nobody can work lobbying for a foreign government when they leave office for 5 years. That was their bread and butter.
We'll have more with Martin Armstrong next on This Week in Money.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan district of northwestern BC. Check us out at blindcreekresources.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Martin Armstrong, founder of Armstrong Economics. Martin, if President Trump is able to get his tax cuts passed, will it put pressure on other countries like Canada to cut their taxes?
Most of the other countries will try and fight it as much as possible. And you're looking at deficits in just about everywhere you turn. They don't want to understand that lower taxes does increase economic growth. It's as simple as that. And you have eBay, for example. They wanted to take over an American company. The deal fell through. Why? Because when they looked at it, they had to bring the cash that they had overseas in to buy the company. They had to pay 40% tax on that cash. So they cut the deal, and ran, and that was it. If Trump, were to succeed and lower that to 10%, I would short any company that didn't bring all their money back, because, as soon as the Democrats get back in, it's going to go right back up. I mean, if you look at the tax code of the United States, that's the real problem. It's not the actual level of tax. The problem is, it's been like a brainwave of schizophrenic or something. I mean, it was up to 90% in the 60s, and JFK did the first tax cut. And then you had Reagan come in, and he cut it again. We put a chart out on Britain. What the press puts out and what the politicians say is just flat outright a lie, period. Take the Brit exit. Oh, we leave Britain, the economy will decline, etc. I put out a chart. I used the government's own GDP, which is there. All right? You can pull it down off the government sites. The peak in GDP growth was 1973, and it's been nowhere but down ever since joining the EU. Yet they stand up and they make people think that it's exactly the opposite. The data is it's incredible, but the press and the politicians foster nothing but propaganda.
Are the U.S. and Canada likely in for a Japanese-style recession?
We've been going through this, and if you just look at what economic growth was during the Reagan period, you're looking at 6 to 8%. Now they're cheering if you can get to 2. This is what they don't want to concede what actually happens. If I give you $100 and then I say you have to give me 90 back, what did I really give you? 100 or 10? You keep raising the taxes, and what happens is you're lowering the standard of living for the average person. You take women's rights and always, women right to work, etc., etc. Now it's really the opposite. Most of these families that are starting, It requires 2 salaries. It would be a luxury for the woman to be able to stay home. I mean, how much has changed from 1930 to today? It now takes 2 salaries to support a family that when it only took 1. And just look at how much government consumes of GDP. On average, on a global scale, it's 40%. So 40% of every dollar is going to government for their pensions, their employees, etc., which produces absolutely nothing. They don't manufacture any widgets or anything else. It's like you just hired a maid and she's in your house, and that's it. She doesn't increase your income. She might, be there to assist you, but that's it. And government, fine. If it's going to cost 10, 12% of the economy, that's reasonable. At 40%, we're approaching 50% on most of these countries around in the West. That's insane.
What do you see ahead for the U.S. dollar?
The dollar has actually nowhere to go but up. And mainly for that, you have to look at what's happening on a global scale. And Europe is an absolute basket case. The design of the euro has never been, from day one, been correct. And what they did effectively was there was too much objection, mainly coming from Germany, to consolidate all the debt into one. And, I mean, I met with them when they came to us to help in designing the euro. And I told them from the very beginning, the euro's going to fail. If you want to compete against the dollar, you have to have a single debt market. Then the big money, you're talking about institutions and retirement funds, etc., can park in your government bonds. If you don't do that, there's no place to park the money. And I know a lot of people keep, dollar with the debt. U.S. is $18 trillion is nothing out of $152 trillion worldwide. And you have emerging markets. Their debt is half that of the United States, and their economy is about 20% of the U.S. Europe is just look at it this way. I mean, Draghi with the ECB has put interest rates to negative. Now we're approaching 10 years, and it has not been able to stimulate the economy. What's happening? You keep raising taxes, you keep imposing more and more regulation, and then you expect to be able to stimulate the economy by just bringing interest rates down, and then suddenly that didn't work. So, we'll punish them if they don't spend their money. So then they just take cash out of the bank. The number one selling product in Germany and Switzerland, for the last couple of years was the home safe. So, I mean, it's just, we're going down a road that honestly leads nowhere fast. And there's just nobody in charge of any government anywhere that is interested in doing the right thing. They don't even understand what the right thing is because they're career politicians. They have no experience whatsoever.
Is real estate around the world already in or heading for a crash?
Yeah, I mean, you had very big booms, but it was all largely capital rushing away from one place to another. I mean, there in Vancouver, it was mostly Chinese money fleeing, trying to get out of China. In Britain, the British property market took off in London. Why? Because it was all foreign money coming in. Same thing in Australia. In the United States, it was all foreign money coming into New York and Miami. So it depends the region where you're at, but basically real estate was another means for capital to get off the grid. And by that I mean out of government bonds and someplace to put your capital. And real estate tends to peak out first. Even if you take the booms in the roaring 20s. All right, you had the Florida land bubble burst in 1927. When the real estate starts going down, what's left? Then capital rushes into equities, and that's what we're seeing.
We'll have more with Martin Armstrong next on This Week in Money.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Martin Armstrong, founder of Armstrong Economics. Are we likely to see a spike in interest rates in the second half of the year?
We're probably looking at a real serious financial crisis hitting by next year. And by that I mean that, look, in Europe, the EU is trying to come out with the same exact type of instrument that blew everything up in 2007. They pooled together all the real estate, and they were selling this stuff off, and that's what blew up. So because Germany will not consolidate the debts, and Germany really rules the rest of Europe, what happens? So the proposal now is to issue a euro bond that is exactly as the CDOs were in 2007, except pooling together all the bonds of the various member states of the EU, and then that would be a euro bond. It's still not the same thing. It's a derivative. But why are they doing it? Because the ECB needs to be bailed out. We're looking at a central bank that's effectively bankrupt. Now just ask yourself this question. The ECB, after 10 years almost of trying to desperately stimulate the economy, it now owns 40% of all the national debt of all member states. Now, that's a huge number. All right, but what happens if the central bank stops its quantitative easing? That's why they have not dared to raise rates yet. If they stop, who's going to buy the debt that's coming out? The ECB has basically funded all the European governments there. They've been on life support. They could spend whatever they wanted because the ECB would buy it. Now, if the ECB stops, we're looking at interest rates going up quite dramatically because the question becomes then, who is going to buy the debt? They've wiped out the bond market. The EU is now, they're scared to death of the financial crisis that's coming. So what do? Government never admits a mistake. They're now trying to pass laws and to take the derivative markets on the euro out of London and must be moved to Paris. Why? Because they'll pass laws and control them. They've already outlawed the right to short government bonds or stocks over there. It's called, naked short selling. You can't do that. It's illegal. They think that this somehow will prevent the markets from crashing on them. All you're doing is chasing everybody away.
Are lenders starting to restrict credit around the world, including China?
Oh, China, yeah, sure. I was just over there. I mean, it's you have the same problem where the people don't necessarily trust the government, so they've been trying to get their money out one way or another. And real estate's one way, to park money, but the loans are being cut, things of this nature, and I mean the prices that real estate soared to in Shanghai were just absolutely astonishing. It clearly reminded me of Tokyo going into 1989.
Are you bullish or bearish on the oil market?
The only reason oil would go up would be basically for a war. Other than that, it is still in a position of excess supply, and declining demand. You have the advent of a lot of electric cars have become quite interesting in the sense that by 2020 you have to have mostly electric cars in Europe. But you have Teslas and BMWs, etc., that are you're reducing the demand for oil. Things have become much more efficient over the years, and then at the same time, the production in the United States is increased to the point the U.S. is self-sufficient and a net exporter now. So it's kind of hard to see oil going, to $200 a barrel type thing. But the major resistance is up in the $56 area.
Does silver usually precede gold in going parabolic?
No, not really. The two of them are, it depends entirely upon what goes and comes. Silver made its big high in 1919 on that commodity rally, and then fell, into 1932. So it all depends upon what is going on, but silver, at least in coin form, if you buy the old coins before 1964 and back, that's probably better than the bullion, I would think. But things have changed. Governments need money so bad that it's becoming really like 1984. I travel around a lot, and I am getting routinely pulled over. How much money do you have? I was meeting with the government in Brussels, and I hopped on the train to go over for meetings in London. So I went through the tunnel. I got to London. Because I just came out of a meeting, I was in at least a suit and tie. Everybody else is really in jeans and sneaks on the train. I'm the one pulled over. And I looked at it and I said, me? And, yeah. How much money you got? I said, look, I'm an American. I'm just here for a meeting. That still wasn't good enough. All right? And then he wanted to see where I bought my ticket. I said, see, I bought it in Brussels, and I'm returning to Brussels. All right, they finally let me go. But I have a friend just went to go see his son in Paris. Immediately getting off the plane, come here. And they're just shaking down everybody they possibly can. So the danger of that is that, gold used to be a movable object. I mean, you could put it in, take a few ounces, stick it in your pocket, and hop on a plane. It was no problem. Today, good luck. You can't, throw a bunch of gold in a briefcase and hop on a plane anymore. They will confiscate it. As simple as that. I mean, they're looking for $10,000 or more, and they'll go below that $10,000. Don't think they won't. When I was over in Poland, it was $10,000, anything of value.
So if you're wearing a designer, cash. I was going to say if you're wearing a designer suit.
Exactly. I mean, in Italy, if it looks like you have too much jewelry on, they pull you over and they weigh it. I mean, this is indicative of what I'm saying, why the stock market will go up and why the bond market will go down. And it has nothing to do with earnings. People are completely delusional there. It gets to a point in these financial crises long term where it's not a question of is the economy booming and they will earn 6% versus somebody who earned 3%. The question becomes, where can I park my money that I know I'll at least get some of it back?
What would be needed for silver to go through $50?
Those types of things, and you have to keep in mind, even hyperinflation. I mean, these people have done very shoddy research. They don't even understand what it's about. And look at quantitative easing in Europe or the Fed. Increasing the supply of money does not create inflation. If people are hoarding it, that's fine. You take what the Fed did. Really, they brought in the bonds, then the banks complained, we don't have a place to put the money. So then the Fed creates excess reserves. And you had almost $3 trillion sitting there. That should, how did this stimulate the economy? It never got to the average person on the street. So all this quantitative easing that governments do, it basically helps the banks. That's it. It does nothing for the economy. So the question where hyperinflation really comes about, or you're going to get a big surge in the metals, it's a question of when do people lose confidence in the system itself. That's what is necessary. It's the confidence level. And things change with time, so we got to understand that. It's, go to a Starbucks or something, stand in line, and you'll see that virtually every person under 30 pays with their cell phone. Money to them is just not, it's not what it used to be. Electronic is fine. It doesn't even have to be physical paper money. So, you're talking about, first the dollar has to go up dramatically, and as the dollar goes up, you have to understand, and currencies operate different than markets. A strong dollar brings down the economy. A low dollar makes it boom. All right? So, when I say we're looking at a very strong rally in the dollar, that is the economic decline. If the dollar goes up, what happens? Most of foreign governments, emerging markets, they issued all their debt in dollars. So if the dollar goes down, they're going to be celebrating. All right? If the dollar goes up, their blood is going to be pouring out of every orifice they have. So a high dollar will cause the crash. It was the high dollar in the Great Depression that forced Roosevelt basically to devalue the dollar and confiscate gold in the 34. It was the high dollar going into 1985 that the pound fell apart. That was the Plaza Accord, the birth of the G5. It's only the high in the dollar when we see these things take place, not the low. To see those types of things comes after the dollar rally. You're probably looking, into more like 2024, 25, going into 30. We have to crack the system first. It's cracking very well. Government is falling apart, and I don't see any prayer of changing it or preventing it. So, no point in grabbing signs and going down to Parliament and protesting in front of it. They'll only laugh and have you arrested for walking on the grass anyhow. So, you just have to stand back and wait. That's it.
What do you see ahead for gold?
Same thing. I mean, gold will go up, but, we're probably not looking at any kind of a commodity rally until we're largely after 18.
Was the recent British election called to put an end to Brexit?
No, it was May misjudging everything, and she thought it would give her a stronger position. The polls, which were wrong, put her at a 20% lead, and when the vote came in, she was absolutely shocked and lost power. And you're gonna, you'll probably see another election soon, and then you're gonna have the real situation, and that is, I've written about this. I really don't think anybody who doesn't pay taxes should have a right to vote, period. If you have no stake in the game, you shouldn't be allowed to vote. And maybe that sounds harsh, but the problem is you have all these students out there who don't work, they don't know what the real world is, and you have somebody standing up and saying, oh, vote for me, and you'll get free health care, you'll get free education, and you'll no longer have student loans. Oh, wow. And they all say yes. They have no idea how is that going to happen. All right? And so they don't understand. So, that's the next generation coming in. And in Britain, they're demanding that the voting age be reduced to 16. A 16-year-old.
What's the biggest story right now in geopolitics?
Largely, it's the career politicians desperately trying to keep up the Cold War with Russia, honestly. And it's, they're trying to keep the sanctions on Russia, and then they lower them against Belarus. And, what this is all about is just really stupid. Crimea always was part of Russia. They gave it to be managed to Ukraine. It's a vital port for Russia, militarily. It's kind of like, what if the shoes were on the opposite, foot? And he said, okay, fine. You have to pull all your ships and everything out of Okinawa in Japan. It's a major base. I think the U.S. would probably object, and if not, bring in military force to keep it. I mean, look, half of Ukraine speaks Russian. They were Russians, okay? It was part of Russia. And, still drawing borders that, look, we're the ones that created all this stuff, carving up the world. The Middle East, we carved up the Ottoman Empire. We're the ones that put in the House of Saud in Saudi Arabia. We're the ones that did all this stuff. Ukraine should have been very simple. You draw the line right down the middle, wherever the Russians, people speak Russian, that's it. You're split off, you're not part of Ukraine. Simple as that. The president of Ukraine, he spoke some Ukrainian, but they made jokes about him because he was Russian. That's what sparked the revolution, because he was bringing in Russian style of an oligarchy.
What are your thoughts on Bitcoin and other cryptocurrencies?
Well, there's two separate issues with them, really. Bitcoin, I think, is kind of a disaster. And in 1966, they had all the mutual funds and stocks listed on the stock exchange. And what you found was that people were bidding up the mutual fund shares dramatically far beyond what their net asset value was. And then when they crashed well below net asset value. So after that debacle in 1966, mutual funds were no longer to be listed, and they just basically, you enter and you exit based upon net asset value. That's the problem with Bitcoin. And people, oh wow, look at how it went up. All right, very nice, but it also goes down. It's not a store of wealth. It cannot possibly be a store of wealth in that type of manner. Now, to create a cryptocurrency that eventually is going to replace things, I mean, sure, that's probably where we're headed, all right, but it can't be one of these things that is more volatile than the Forex markets themselves.
Due to the political division in the U.S., are people less likely to spend their money supporting retailers that clearly show support for one political party or the other, and could that affect the economy?
No, I don't really see that. I mean, I know it gets a lot of press, trying to boycott, Trump's daughter's clotheslines and stuff like this. But, you have to understand is that the press is bought and paid for. It has become so corrupt, it's pathetic. Even when Comey testified, they asked him about two articles, one in the New York Times, one in the Washington Post, and they said, is this true? And he said, no, both of them were absolutely false. Harvard did a study. Over 90% of the press coverage of Trump is always negative. They're trying to desperately destroy the Trump administration. Why? Because they don't want any political change. Simple as that. No reforms. They still want everything, as is, and they're worried about him cutting out the pork. And that's the whole issue.
Was President Trump right to pull out of the Paris Accord?
Yeah, I mean, there's over 31,000 scientists that have basically signed petitions saying this is all bogus. The research of this it goes back to the 1850s. That's it. All right, it totally ignores the sun. It totally ignores everything as far as the sun has a energy. It beats like your heart, and it has a 300-year cycle, which has been documented through countless things. The Paris Accord over there, they refused to allow anybody to speak there that had anything to say that was critical of their research. It's simple. All you got to do is follow the money. I mean, global warming is nonsense. And they charge companies and say, oh, okay, fine. Now, if you're going to go above this level, we'll let you, but you just got to pay more taxes to us. Where are they doing anything? you can't change the environment. Sure, you can pollute things. Okay, that doesn't change, the weather cycles. I mean, this stuff about storms, etc. The biggest storms in history and volcano eruptions and things were long before the combustion engine even existed. Go back to the 1800s. They even wrote a book, The Year Without a Summer, because Krakatoa exploded, put so much dust in the atmosphere that it was still snowing in New York City in July. So, the sun is a lot more powerful than we are, and so are volcanoes. So it's just bogus research. Is typical, and you see the same thing in medicine. I mean, for 25 years they said, eggs are bad for you. Then all of a sudden, it's saturated fat. All right, they found out that just because there's cholesterol in eggs, it's not the same thing that the body creates from saturated fat. So, I mean, so now they go, eggs are healthy to eat. For 25 years, the research that they were putting out was bogus, the same thing. What it is they try to reduce everything to a single cause and effect. I can make an absolute 100% guaranteed statement. Everybody who's ever eaten a carrot has died. So does that mean carrots are lethal? This is the way they do research. And this is why we hear so many times, don't eat this, it's bad for you. And then 10 years later, we were wrong on that. It's okay.
Are governments likely to bail out people that are deeply in debt if economies collapse?
No. Bank Popular in Spain showed what happens with the bail-ins, and this is, I wrote a piece on it. It's very, very serious, and the politicians don't see what they've done. Even Forbes magazine came out and cheered. Because what happened was everybody that owned stock in that company got zero. And they put the bank up for auction and was sold for €1. So if it was an industrial company and went into insolvency, you get something back. That's what I'm talking about. You sell off the land, the buildings, the assets, whatever. Maybe you get 20 cents on the dollar, maybe you get 60%. Who knows? But you don't get zero. And by doing the bail-ins, all right, yes, bailouts, okay, fine. It was the way they did them that was pathetic. But the question of the bail-in, the way they pulled this off of Bank Popular in Spain, why would anybody own bank stocks anymore? I have to advise all our clients, get out of every bank stock, period, because, the next one, that's it. You get nothing.
Martin, how can people find out more about Armstrong Economics?
Basically, you can go to our website. It's ArmstrongEconomics.com. And, you won't find a whole bunch of ads or anything like that on there. We just do it as a public service, mainly.
Martin, thank you so much for being on This Week in Money.
Well, thank you for inviting me.
My guest has been Martin Armstrong, founder of ArmstrongEconomics.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark and Martin Armstrong, and thank you for listening. If you have any questions for the show, you can email us at info@howstreet.com. And right after our show wraps up, we'll have a company showcase update with American Manganese CEO and President Larry Reaugh. Have a great Canada Day. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. We're talking with Larry Reaugh, CEO and President of American Manganese. Happy Canada Day and happy Independence Day, Larry.
Well, happy holiday to you too, Jim, and it looks like it's going to be nice weather, and we're looking forward to it, especially after the announcement this morning where we got most of our $1 million in 2 tranches in the last week. So that's excellent because that clears the way to getting our patents and getting all that work done. And what I'd like to say before I go into that is I'd like to say thank you to the shareholders, directors, and officers that participated in this placement. It was not an easy placement because we had an eroding market all the way through. But that said and done, we're sitting comfortable to get our patents applied for and get our work done. And going a little further on that, I'll be talking about the program in the next week or so in a press release, and we'll also be publishing a progress chart so that people can follow it on our website. So that will alleviate a lot of the questions that we get daily from shareholders wondering exactly where we're at. But it's everything's looking great. The weather is great, the progress is great, and the company's in good shape. So that's not much more I can say about that. Our next part of the program will cost about $750,000 to $800,000. And it'll be over a 4.5-week or 4.5-month period in 3 phases. And, I'm hoping that we can get the drafting of the patent application started by, say, mid-August. So that gives you a brief outlook on where we're going. But what I'd like to also talk about is the price of cobalt is one of the few things that keeps moving up. Today it's at $60,000 a ton. $60,000 a ton is a very significant number when you look at it because it increases the value of the cathode materials in these lithium-ion batteries considerably. It's almost doubled from the time we talked about it in January the 19th. So what does that mean for the future of cobalt? Well, I can see it going up. I took a brief look and refreshed my memory on what was happening in the DRC, and the reason why I talk about the DRC is because they're responsible for about 65% of the cobalt as a byproduct. And most of that comes from 2 or 3 mines, or 2 mines in particular, one that's owned by Glencore, who produces roughly about 24,000 tons a year of cobalt. That's a significant number. And we have to consider that the next one is the China molybdenum producer, which is 16,000 tons. So that's 40,000 tons out of roughly about 60 to 65,000 tons a year. Now, the Katanga mine, which everybody may remember that follows the mining, is expected to go back into production in September this year, and so it'll add something to the cobalt production for the year, but it should have an impact next year, and they're planning on coming back in with about 22,000 tons of production of cobalt each year. That will move the DRC up to 80% of the total world's cobalt production, or between 70 and 80% of the world's cobalt production. Now, the reality is that the reserves for cobalt are quite small around the world, except in the DRC. And the DRC accounts for about 25 million tons of reserves in 3 mines. The 4th largest mine is in Australia, which has 142,000 tons of reserves. And then you have Madagascar at 137,000 tons of reserves. So you can see where I'm going with this. There's no way that we're ever going to get away from purchasing cobalt from the DRC. And the only way that you can be sure you're not getting it is if you are buying recycled material. And that's what we're working towards, getting recycled material out there. And that's what this last financing is all about. We're just moving that project ahead. Now, again, Glencore controls 66% of the 5 largest producers of cobalt. And that tells you that Glencore is sitting in a pretty good position. How could they increase their production? Well, they'd have to increase the production of copper. And in the short term, because of the copper prices, that's not going to happen. And the same set goes for nickel. So where's it going to come from? Well, there could be some primary producers coming along, although primary producers only represent, along with recycled cobalt, about 4% of the total world production. So the reality is, it's the big question mark. Where's it going to come from? We know Katanga would come back on. If it comes back on in September, we'll bring 22,000 tons. That will alleviate an immediate crisis, but that's not going to be a long-term solution. The long-term solution is bringing some recycled material from these lithium-ion batteries, which represent 45% of the cobalt that's produced each year, on stream. That doesn't mean there won't be new production, but it does mean that it will alleviate some of that. So that's what we're working forward towards, and we are looking at a model that would use scrap material initially, because there's a lot of hullabaloo about the fact that there won't be enough lithium-ion batteries to make a difference for another 10 to 15 years. But what most people don't realize is that when you're producing the cathode material, to make a battery, there's a rejection of 10% of that material each year. So just as a mathematical exercise, that could represent 4,500 tons of cobalt a year. And the more they use, the higher that number goes. Now, what makes that interesting to us is the scrap material would be probably the most economic throughput that we could have, regardless of what it's made up of, as long as it's made up of all the chemistries or some of the chemistries that we've worked on. And because you wouldn't have any disassembly. You just have the aluminum foils with the cathode material on it. So that's kind of where we're going to be focusing our attention in the future, is to start out somewhere with rejected material. And we think the market would come to us on that, because if you have a few hundred tons of cobalt locked up in cathode material, and you can send it off to a recycler and get that back at whatever deal you want to make with us, that's where it's going to go. It's going to go to anybody that's recycling the cathode material, and hopefully that will be us. So just to give people an idea that the company's thinking a little bit out of the box, and we want to move forward. And don't forget the tipping fee. Right now, even yesterday, I got an email from the United States, from a municipality who collects lithium-ion batteries in 5-gallon pails, and it costs them $350 US to have somebody come and take those pails away. That's a tipping fee, and that's a tipping fee that is being charged whether you're a battery manufacturer or you're a municipality that's collecting the batteries. It doesn't matter. It's a tipping fee that goes onto into the till of the company that's doing the recycling. But anyway, that's just a few thoughts. I think I mentioned cobalt because it's now $60,000 a ton.
And it looks, in my opinion, and I used to write about the commodity prices moving forward, I believe that there's lots of life left and lots of legs left in this cobalt rally, and it may correct. The rally is going to be pretty consistent as long as the EV car sales keep going up. That said and done, Jim, I just want to wish our shareholders out there a very happy holiday, so that come back whenever you get back, Wednesday, Tuesday, and looking at a fresh page.
Larry, can you just give us a little thumbnail about what American Manganese is all about?
American Manganese is all about taking its proprietary patented technology and utilizing it and streamlining it for the recycling of lithium-ion batteries, especially EV cars. And anybody can get information on us at our website, which is AmericanManganeseInc.com, or email me at lreaugh, L-R-E-A-U-G-H, at amymn.com, or phone me at 778-574-4444.
And what platforms is American Manganese traded on?
American Manganese is traded on predominantly on the Venture Exchange under the ticker symbol AMY, and it's traded in the United States under the ticker symbol AMYZF, and in Frankfurt under the symbol 2AM.
Happy holidays, Larry.
Happy holidays, Jim.
My guest has been Larry Reaugh, CEO and President of American Manganese. We were speaking on June 30th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.